Welcome to Financial Discretion Advised. I'm Abrin Berkemeyer.
I'm Tyler Hafford. Let's cue the music.
All right. Thanks, everybody, for joining us today. As you can tell, our introduction is pre-recorded because Tyler's not with us today. I guess we're not worth his time. But we do have Sam today, and he is going to be joining us to talk about inflation. And we'll probably throw in a couple other words in there, deflation and stagflation, talk about those a little bit. We'll see if they get peppered in. But Sam is our associate portfolio manager. And how you doing?
I'm doing good. Yeah, we consider just never acknowledging that I'm not Tyler and we could just replace him like some old sitcom character or something. But I guess we're past that. But I am good. Happy to be here. Talk about inflation.
Right. Yeah.
Hot topic at the moment.
Welcome to the hot seat.
Yeah.
Just me and you, and just gonna grill you. Really make sure you have a great time. But yeah, I think why don't we just start out with what inflation is, kind of get the audience familiar with it. I think there's kind of two definitions of it. So I'll let you pick one and I'll pick the other one by process of elimination.
Sure. So I think most people are familiar with what inflation is, just a general increase of prices or fall in the purchasing power of a dollar. I know a lot of people would use like penny candy as an analogy. Wasn't around for penny candy, so I might use like a bottle of Coke out of a machine used to be $1 and now it costs $2 at a minimum, which is pretty crazy. So just that general devaluation in the dollar over time that happens from increasing the money supply.
Yep. Yeah. Well, I guess you really did hit both on the head there. I thought you were either going to pick the devaluing of the dollar, or kind of the other common one is the increase of the cost of goods or services. So you got both covered there. Sam covered both. I covered both. You're very well versed at this point. But yeah, that's what inflation is. You gave some great examples. I tend to use similar examples in my conversations with clients when we go through a financial plan. Obviously, inflation is a big factor over time. I have a sweet tooth thanks to my mother, and I always go with the Hershey's candy bar example, because there's some news article out there where back in the World Series, like the 1930s or something, a Hershey's bar was like a nickel at that game, and then obviously they use the example today where now if you go into Target, like a Hershey's bar is like $1.50 or whatever. So you can really tell
it's
that
probably smaller than it used to be too. That's called shrinkflation. We don't talk about that very much, but you've seen like Cadbury eggs over time just getting smaller and smaller. More expensive at the same time.
I noticed that with Powerade recently. So I get a lot of Powerades on the weekends for my gym workouts, and like they had a 32-ounce bottle, and now it's the exact same style and everything. They didn't change anything about the bottle except it's now 28 ounces and it's the same price. So
just slowly eroding.
Right. That's another way that you can really get into inflation and kind of offset the costs on the producer side versus the consumer side. So why don't we talk about what some of the causes of inflation are, get into that a little bit.
Yeah, good segue there, because inflation can come from either the supply side or the demand side. Can come from a lot of reasons, but from a high level, it could be what's called a cost push or a demand pull. Cost push being from the supply side of, maybe input prices are going up, whether that be raw materials or labor costs. Maybe there's issues with the supply chain. The ship gets stuck sideways in a canal somewhere. And then also maybe like just deterioration in the terms of trade war type of things tend to put upward pressure on prices on the supply side. And then flipping over to the demand side, it really has to do with consumer spending, which is, a product of wages, also a product of people's incentive to either save their money or spend it. If you're saving your money, you're not going to be putting that demand on prices. It's hard to push prices up. But if you're spending it, that's what will push prices up. Same with government spending. Government's borrowing and spending a lot of money. That'll put upward pressure on prices. And then from the foreign aspect too, the trade balance is another way that prices can be affected, depending on whether importing or exporting more money and just the value of the dollar versus foreign currencies. So that's why we watch both the producer price index on the supply side and the consumer price index on the consumer side, or the demand side rather, over time to see which one of those is, or if any of them are putting upward pressure on prices. And we can talk a little bit about those numbers. At the moment, the trailing 12 months, the producer price index is up about 4.23%, where the consumer price index is up about 2.6%. And those are really just measuring baskets of securities or products rather, where on the producer side, it would be like the raw materials, and on the consumer side, it would just be a basket of goods that people are generally using. So those are some fairly high numbers at the moment, considering over time. They tend to average around 2% over the last 30 years or so. We'll get into a little bit of the history of inflation, I think. But that's where we're at right now.
Yeah, if any of our listeners or viewers, if you can't tell, Sam is a very wicked smart guy, wicked smart bub. You really get into the technicals on that.
All right.
But I appreciate it because it's all interwoven and is exactly the reasons why inflation happens, and definitely for certain different areas of the economy. And
yeah, it'll come back into play later. You'll see.
Yeah, gonna come full circle on us.
Yeah,
Yeah, put it more in layman's terms. So essentially a lot of what I'm hearing from you is supply and demand across the board. Everything you just talked about was supply and demand, whether it's international or domestic, or what goes into the product. There's always the supply and demand. So really, when I think about inflation and even market prices in general, it always boils back down to Econ 101 from college.
Exactly.
It's like they don't let you leave without drawing the supply and demand graph and understanding the shifts in that movement. So, if I had to boil it down for any of our less technical clients or prospects out there, supply and demand is obviously the leading factor, and just how it gets intermixed into the ultimate indices and things that we watch for inflation.
Yeah, those are the ways we measure them for the most part. We've talked a decent amount about inflation. Probably, like you said, good to mention deflation and stagflation as well. So a small amount of inflation is actually good for the economy. It's what allows it to grow. Deflation would be the opposite, where the purchasing power of the dollar is actually getting more powerful over time, which sounds really good on the surface, but can have all kinds of unintended consequences for economies. For example, if the dollar is getting stronger, people are going to be less willing to spend it than they are to save it. And if people aren't spending money, that's bad for the economy.
Right. And then if I could go buy a refrigerator for $1,500, right?
Yeah.
But tomorrow I know it's going to be $1,400. I'm not going to buy that refrigerator today because I know that tomorrow my dollar is going to go further and buy me a refrigerator for $100 less. And so, if that trend keeps going on, then I might not buy a refrigerator for a couple of years until it drops down to $200 and I can get a really nice fridge for a sweet deal, and just never pump any money into the economy because I'm incentivized to continue waiting.
Yeah, for sure. Absolutely. It's funny. We were talking, everybody has their analogy about inflation, whatever product they use. And Abrin's was a couch. He just stole my refrigerator, which is what I use. I don't know where that comes from. Maybe it says something about our personalities, but I guess it's probably not good either.
Yeah, you like to eat, I like to lounge.
But yeah, you got it exactly right. And then deflation on the borrowing side is bad because you wouldn't want to borrow money today if that, those dollars are going to be more powerful that you have to pay back in the future. You'd kind of be paying interest in more ways than one, right? You pay your interest rate, but then you'd also have to pay back more powerful dollars, which isn't good for growing an economy either.
Yeah.
And then stagflation is really the worst of the worst, where you're having inflation as well as high unemployment in the economy, and that's a killer.
Yeah, it's the one that I think people that are worth their salt, like yourself, can throw around and use wisely, but it's harder to understand than the basics of the inflation.
Yeah, it hasn't been a factor in this country.
Yeah, but it is a very when stagflation does happen, like you said, it does get to a very dangerous environment. But speaking of environments, obviously inflation changes over time. We go through different periods of the U.S. where goods and services cost different amounts of prices. So why don't we talk about a little bit of the history of it? I think probably the one that resonates with a lot of our clients, especially the older clients, would be going through the 70s and 80s.
Yeah, absolutely. You look at a graph of like the CPI, consumer price index over time, and it's just really spiky and then keeps dropping off. It's almost like an EKG of somebody kicking the bucket. But back in the 20s had massive spikes up to like 23%, dollar losing 23% of its purchasing power in a single year versus, and then the 70s, it was about 14% at the highs and lagged into the early 80s a little bit.
Right. So that was affecting debt and savings, right? Like if you're looking for a mortgage, you're like, oh wow, I got to pay 14%,
right?
But then also if you're putting your money in the bank, it's like, oh wow, I'm earning 14%.
Yeah, it's interesting. You kind of pay one way or the other. My parents say how hard it was to pay their interest rate on their mortgage initially, but their house prices were so low, and now house prices are super high and mortgage rates are super low. But it's interesting to see studies about people who live through those times and how they invest. People who lived through the 70s are much more likely to invest in things like gold and in treasuries and commodities, where people who haven't experienced inflation in their lifetimes are much less apt to do those things.
Right.
But then, as we said, since the 90s, really about 1990, inflation's averaged about 2% per year. And that's kind of despite increases in the money supply. We'll talk about that a little bit, but for a while now, the Federal Reserve has been targeting about 2% inflation per year. And the way they do that is lower interest rates, people borrow more, create more money, and that pushes up inflation. And if inflation gets too high, they raise the interest rates, but they haven't had to do that too much. To be honest, nobody's quite sure why inflation has been so low, for the past 30 years. It's something that's a lot of debate about. Be wary of anybody who tells you they do know. But there are some theories. Some of them I think hold some water. One is surrounding total factor productivity. Sorry to get technical again, but kind of a fancy way of saying technology and increases in efficiency, where one way to think about inflation is that you got too many dollars chasing too few goods, right? And that pushes prices up.
Yeah, let's go back to our couch analogy for a second.
Right. So refrigerators.
So like the couch, right? So say you got the couch and it's on sale for $1,500 for the couch, just about the same as the fridge. Say they need to sell 10 couches to meet their goals and their revenue to stay in business. So they order 10 couches and they're going to move that product out over time for $1,500 and they'll be able to meet their margins. But then what if more than 10 people want the couches, right? So maybe there's 20 people out there that are going to go out and buy these couches. The store doesn't have the money to go out and get new couches, or maybe the production of the couches can't take place for a long period of time. So they've only got 10 on inventory, but there's twice the amount of people that want those couches. Why don't they just jack the price up?
Yeah.
And then maybe they sell the couches for $1,600 instead of $1,500 because you've got less couches with more people going out trying to buy those couches. And then you kind of get that kind of spiral effect of eventually you'll hit a limit where those 20 people all are going to kind of agree on a kind of a market consensus that they're not going to pay more than say $1,700 for the couch. And then the salesman sells their couches for $1,700 and they can't sell it for any more than that. But
yeah,
they can't just magically drive up the supply, even if the demand is ready to meet it. So
yeah. And to stick with your couch analogy, say 50 years ago, there was some guy in a workshop building this couch and he could only produce 5 couches a year. Shoot forward 50 years and we're mass producing couches out of factories that humans aren't even touching. So the total factor productivity argument is that we have become so efficient in producing goods. Technology is growing exponentially. We're pumping out more goods than ever, per year, more and more and more. We need more money to chase those goods.
Right. Store owners on the phone saying like, hey, I need 20 couches because I got 20 people that need them. And the couch builder's like, oh yeah, we'll get you those tomorrow. So that way you don't really reach that inflationary point where those 20 people are all competing against each other over a certain period of time.
Yep.
Yeah.
That's one argument is that, where our capacity for creating goods and services had expanded so fast that we need more money to chase those. Otherwise we get deflation, which we talked about is pretty bad. Another couple of theories, or one about aging demographics in this country specifically, is that the older people get, if they earn more money, they're more likely to save it than they are to spend it.
Mm-hmm.
So when you have an older population, which a lot of us know the US does have an older population, when there is more money coming in, it goes into their bank accounts, doesn't go into the products that are going to cause inflation and spike that demand. And somewhat similarly is changes in the wealth distribution in the US, where a lot of the new income is going to the upper wealthy regions of the US income spectrum. You heard Bernie Sanders say anything, you've heard him say that. So what we're talking about there is, if you have a really strong middle class and wages are going up really fast, they're going out to grocery stores and buying gasoline and all this stuff we're worried about prices going up in. But somebody, if you're making a ton of money as a single household, you can only buy so much of those goods and services. Maybe you go out and buy a new helicopter for your yacht or something like that, and helicopter prices go up.
New yacht for your helicopter.
So the changes in the wealth distribution in the U.S. is, has plenty of bad things about it, but this isn't one situation where it actually helps suppress or put downward pressure on inflation. Another interesting theory that's very controversial as soon as like a few years ago and has become a lot more talked about, accepted. I don't know, still pretty taboo, but something called modern monetary theory, which kind of flies in the face of a lot of the old economic theories about inflation, and says that basically if your country has the world reserve currency, you can print and create and borrow a lot more money than any other country could, because you always have those foreign buyers to come in and buy your debt or buy your products.
Right. And that's one I found really interesting because, you know, when you think of it like that, it's all relative, right? Because like you could go out to Germany or Japan and go take out some debt and they're going to charge you a negative interest rate.
Yeah. Yeah.
And so you're not incentivized to do that. So, you know, if the US is that kind of that world reserve currency and the place that you can go out and get the most secure, highest yielding debt, then even if everything's on the downturn, if we're still on top while all the other countries are going down, then even though the US is less, or even though US debt is less appealing than it might have been a year or two or a decade ago, if it's still the best debt that's out there, then you're going to get people flooding to that debt. So it keeps it all relative, which is really interesting to me.
Absolutely. You'll notice lately when they're having treasury auctions in the US, people will really be watching the foreign buyers and seeing if the central banks out there are still buying up US debt.
Yeah. And I think we could go off a total other tangent on this and talk about e-currencies, but I think just a quick note, that's one of the most interesting things about Bitcoin to me is the you know, the international use of it to do international trade deals with Bitcoin rather than in US dollars.
Yeah.
That's obviously.
So we're actually going to talk a little bit about Bitcoin in our investment commentary coming out in a couple of weeks. It's a little teaser there, how it's actually.
Stay tuned.
Stay tuned. Yeah. Looking at like gold has been a traditional inflation hedge, has not been doing its job, at least so far this year. And Bitcoin's been moving kind of in lockstep with inflation expectations and treasury yields. So pretty interesting. Still too soon to have too much confidence either way.
I know that's what it's the best part of Bitcoin. It's like you get so much attention and so much. It's so fun to talk about, but then it's always preface at the end. Or, well, not preface, but caveat. You know, caveat at the end is, but it's still too soon.
Yeah. I do not recommend this for everybody for sure.
Yeah, definitely a ton of risk obviously involved in that, and that's why we have disclosures at the end of the podcast. But why don't we talk a little bit more about recent history? Let's talk about like the past 10 years and moving up to today.
Yeah, I'd probably go back to the great financial crisis actually, because if you look at increases in the money supply over time, it was kind of a straight line for a while, and then come 2008, 2009, there was quite a big bump up there, and people were having a lot of the same. I don't know. But a lot of people having the same type of conversations we are right now, are printing too much money, taking out too much debt.
This is going to be really super bad. Interesting part. It is like, because back then we printed off a ton of money.
Relatively at the time, it seemed like so, and now we just blew that out of the water the last year. But the interesting part, maybe the reason we did blow it out of the water this year is that, you know, if the penalty for borrowing too much money and printing too much money is that you get inflation and you get a weakening dollar, we did those things in 2008 and we didn't see either of those things happen.
Right. That was a super interesting part over the past decade is we didn't see inflation above 2%.
Yeah. Like the Fed would keep interest rates low, trying to target that 2% level and still come in below the 2% inflation target, which is really interesting. And now they've pivoted saying they want to try targeting a little bit above 2%, maybe around 2.5%. So a lot of economists nowadays are saying, maybe we underplayed our hand in 2008. Maybe we should have gone bigger, right? If we did what we did and saw no penalty for it, then why can't we do more? So now that's kind of a inflation hawk versus dove conversation going on right now. People kind of old school versus new school economics, which is pretty interesting. It's tough because you don't want to bet against like the history of economics, but I find this kind of hypocrisy a little bit in financial advice of, one, don't bet that things are going to change from the way they've always been, but two, you know, future returns or past performance is not indicative of future returns.
Every performance disclosure.
So, you know, you have to be flexible. A lot of these things with theories, you realize that economics is as much of an experiment as it is a science, at least. And if you get too rigid with it and things change, you can get left behind. So I'm not saying that we won't see inflation. I'm saying those are some of the reasons that potentially inflation has been subdued. And maybe there is less reason to worry right now with the amount of money printing we've done than if we'd done it a long time ago, producing a lot more goods and services, different demographics, different income distributions. Things are, obviously a lot different than they were in the 70s or especially the 20s.
Yeah. I guess I've still got my old school clothes on and my old school train of thought. I definitely do fall into the bucket where it's like, eventually something's got to give.
Yeah,
is where I'm at, like, in relying on the old theories. So
I mean, that's what we were all taught, right? If you went through business school, you've been probably going through business school now. That's what they taught you.
Well, I think I got up to econ 102.
Print money, you get inflation. You borrow too much, your dollar, your currency weakens. It's, I guess, not as much of a 1 + 1 = 2 type of thing as we thought it was for a while. And they're just a lot of multifaceted, factors that go into it.
Yeah. I do see a lot of concern for high inflation going forward, though. Like, personally, the only thing right now keeping inflation down is travel. If you go on the government websites, you can go see the rolling year inflation. Almost everything is up above the 2%. Obviously, there's some places that aren't up above the 2% mark, but a lot of them are. A lot of the ones that people see in the client conversations I have is obviously the one that everybody sees is, well, two really: food prices.
Yeah.
You can go look at the numbers, or you can just look at your grocery bill and be
Right.
like, okay, over the past year, obviously food prices have gone up.
Yeah.
The other big one is obviously fuel.
Energy.
Energy's just gone up huge recently.
But
But
that's another important distinction is the CPI. There's kind of two flavors. There's the full CPI, and then there's just core CPI, which excludes fuel, energy prices, and food prices, because they are the most volatile and just have a lot more factors that can drive them.
Yeah, but they do hit everybody.
Yeah, no doubt. They're the most important.
Yeah. And so travel was the only one that's still depressed on the rolling year. Looking at it from the past, updated through March data, it was down like 15%.
Yeah.
Everything else was up anywhere from 1 to 2%, pretty mellow, or even higher to 3 to 8%, depending on where it is.
Yep.
So
an interesting thing there too is, I don't know how many other people are nerdy enough to listen to the Federal Reserve talks, but you hear a lot about the transitory nature of inflation right now because of the baseline effects. And basically all that's saying is that, if we're comparing year over year inflation right now, we're comparing prices right now to prices in April of last year. And I think we all know, if you can remember back that far, April of last year was not a very normal time. There was like rolling shutdowns across the US.
Yeah, that's right. Right about when they all started.
So we talked about demand spikes pushing up prices. Demand falling off a cliff really brings prices down. So we're comparing those suppressed prices from April to the prices now. And it's a good thing that prices have gone up since then.
Right.
So that's the baseline effect. And as we move forward and, the prior year we're comparing to gets into more normal times, we'll have a better gauge of inflation and potentially be lower.
I definitely should have bought my Jeep a year ago. Gas prices are so much cheaper.
Yeah, they really bait and switch there.
Right.
We said the Fed is targeting about 2.5% going forward.
Yeah, they
planning
want
on
to
keeping
run a little hot,
keep interest rates low a little longer. And so far, the market's been buying what the Fed is selling. There are ways of, calculating expected inflation out of things like the Treasury market. Going to get a little technical again for a second, but if you think of a normal Treasury bill, right, it's government debt or bond that doesn't really have any default risk. It's just the real rate of return plus a premium for inflation. So say that's yielding 3%. Really, it's like 1.5. But anyway, to keep the numbers positive, which historically they have been. There's also something called the Treasury inflation protected security, which is just the real rate of return you get, but then they also
tips.
Yeah. They also pay you whatever the actual inflation was over the period of the bond. So if you compare the Treasury yield to the inflation protected security, you're really just gauging what that inflation premium is built into the Treasury bond. So say the inflation protected security is yielding 1% plus inflation. The Treasury security, straight Treasury security, is yielding 3%. That means the market expects 2% inflation over the period, on average over the period. And right now, over the 10-year period, the expected inflation rate is about 2.3%. So that really does match up well with what the Fed is selling. And then to talk about the transitory effects, even more technical, but you can use the futures market to say in 5 years from now, what will inflation be for the next 5 years? So if you took that 10-year period, broke it in half, and you're looking at just the second 5 years now, it's even lower, around 2.11%. So like I said, the market's really buying what the Fed is selling so far.
Yeah.
Inflation's going to run hot for a few years and then come back down around that 2% level.
Yeah.
So it's been priced in more on the short end of the yield curve than it has been in the long end.
Yeah, stands to reason too. The most interesting number that I've seen that I talked through with clients is 2020. We printed 20% of all the money in circulation in the United States. Was printed in that 1 year.
$1 out of $5, massive amount of money.
Yeah.
So it's hard to, when there's that big of a shock.
Right. So that makes sense. You're talking like a 5-year window and people are expecting inflation. It's like, okay, well, yeah.
It's understandable.
It lines up with the old school logic, and it seems to be borne out in the math as it stands today.
Right.
Obviously, the math will change going forward as the market changes. But
if you compare the marginally higher inflation to like the downsides, if we hadn't to spend that money, it's almost too big to comprehend. But hopefully we come out on top.
That's why we have computers. I want to relate it just to everybody's kind of portfolio, and then I'll kind of wrap it up on some planning notes for how inflation affects financial planning outcomes. But do you want to take stocks or bonds?
How about you take bonds? I'll take stocks.
Thank God. Bonds is so easy.
So
all right. So a real easy concept for everybody here. So bonds are just debt securities that you purchase. And when you do that, essentially you're loaning company XYZ $1,000 at 5% for 5 years. Over those 5 years, they're going to give you $50 a year. And then at the end of the 5 years, they're going to give you $1,000 back. And so that's the way that's structured. So you're giving them that 1,000, you're going to get 50 a year, you're going to get the 1,000 back in 5 years. But if you've got inflation over that time period, that is devaluing the dollar. By the time you get your 1,000 back, it's not going to be worth as much because you're not going to be able to buy as many goods and services each year. That $50 you get is going to be worth a little bit less than $50. And then when you get the whole 1,000 back at the end of 5 years, like I said, it's going to be worth less. So in rising inflation tends to negatively affect bonds for those reasons, just because your value of the dollar is going down, even though you're getting the same dollar value back, and it's kind of slowly eroding the value of those coupons that they're giving you along the way.
Yeah, you kind of got to get over that inflation hurdle before you actually start to make money. So the bigger that hurdle gets, the more return you need on your bond.
Yeah, exactly. So what about stocks?
So somewhat of the same characteristics from a different angle. So one of the ways you evaluate stocks is that you say, based on the riskiness of this stock, I expect this amount of return out of it. Otherwise, I'm not going to buy it, or I'm going to sell it, depending on if you're holding it or not. So that's your required return. And when inflation goes up, your required return goes up as well. Same idea. You got to get over that inflation hurdle before you actually start to make money. So if I need a 7% real return on this stock to make it worth my while, and I expect inflation to be 2%, now I need a 9% return on this stock. Inflation goes up, I need a bigger return, which means I'm not going to buy it unless I think the price is more materially undervalued from its intrinsic value. And then the other way that's been playing out in the markets recently is that, rising inflation, it's kind of a second order effect. So rising inflation increases bond yields, increases interest rates, which increases the cost of capital for companies, particularly growth companies that really rely on borrowing to be able to fund their expansion projects. So when interest rates go up, their cost of capital goes up. Some of those projects that might have been feasible when interest rates were low are no longer feasible. And you've seen it play out a little bit in the markets recently, where days where interest rates go up, the growth stocks take a dive just because they're not going to have as much profitability in those projects as they might have if interest rates were lower.
Yeah, and then that translates right into the kind of the real rate of return. Was it something you threw out there while you were talking? And I think it's a really important one for clients to understand too. Like you said, when you have a 2% inflation and you're trying to gauge how much you're going to get from a stock if you have a 7% target, then maybe you need a 9% target for that. So what we would call the 7% would be your real rate of return after inflation. If there's 2% inflation, the stock returns 9%, your real rate of return is 7%, because that's what your buying power is. And that the higher that inflation, the lower your real rate of return, right? So if we had a great year in the stock market and the stock market was up 15%, but we had hyperinflation and inflation was up 15%, you didn't really earn anything. Your buying power is essentially the same at the end of that year. So that real rate of return is something that you need to look out for within a financial plan too.
We talked a little bit about the tips and the treasuries. What's interesting right now is on a 10-year tips, that real rate of return they pay you is actually negative. It's about negative 80 basis points right now. And then the 10-year treasury yields you about 1.5%, just unreal low. Like back in the 90s, it was up to like 9% or something like that. So that difference between the negative 80 basis points and that 1.5% is how you get that 2.3% break even. I just find it really interesting that the real rate is negative at the moment.
Yeah, super. Yeah. And when it comes to planning outcomes, obviously we include inflation in everybody's plans. Like I said earlier, I always use the Hershey's analogy. But generally, you might get to the long end of your financial plan and you need your portfolio to be able to sustain twice the amount of dollar value spending just to keep your same lifestyle as today. And higher inflationary periods can definitely negatively affect financial planning outcomes. If we plan for 2.25% inflation and lo and behold, we see a higher inflation and we get to 3% inflation, that's going to end up really eroding your buying power over time, and can lead towards negative results within a financial plan, because once again, that real rate of return, if you're earning 7% every year and inflation is 3%, you're really only earning 4%. If inflation's 2%, you're really earning 5%. So that real rate of return really is important, and how much you plan for how much the cost of goods and services is going to go up is super important to incorporate into a plan, and definitely not something to be overlooked when running calculations and running numbers.
I think you guys, don't you usually plan pretty conservatively for inflation, sometimes override it to bump it up a little bit just to provide a little margin of safety there?
We generally go above what the expected average is. So where the expected average has been 2%, we keep that at 2.25% going forward. Obviously, like the past decade, planning for 2.25% or just 2% is a windfall to a financial plan, because we haven't seen the higher rates and it's an average rate. So, even if we see, even if we do see higher inflation at, closer to 3% over the next 5 to 10 years, if that's what ends up happening, doesn't necessarily mean that's going to break a financial plan either, because if we average that with the past 10 years, you're kind of at around 2%. So, it always kind of comes out in the wash in that respect. But definitely for just considering it going forward, if higher inflation is something that you really want to hedge against, it's something that you can build into the calculations and run those scenarios so that you can see how higher inflation affects your plan and what you might need to do today to make a change.
We can talk quickly about inflation hedges. I mean,
if anybody's made it this far into the podcast, they're in it for the long haul,
we might have to trim some of the fat here, but so inflation hedges, traditionally things like gold and commodities, real estate, any type of real assets have tended to be a pretty good inflation hedge over time. Those treasury inflation protected securities I mentioned will get you to at least keep pace with the rises in inflation. New entrants such as Bitcoin and cryptocurrencies were kind of created out of the 2008 crisis as a hedge against inflation and devaluations in the dollar. So that's an interesting one to watch. But I guess I'll leave it there. If you guys want to dig deeper and this hasn't been too heavy for you, check out our quarterly commentary. Be coming out in a couple of weeks.
We'll
talk a little more about inflation.
Told Sam if he comes on, he could plug his own material. So.
Yeah. I was going to throw you guys a plug, but forget about it.
So I'll shamelessly plug us. If you want to catch us on any podcast, Apple, Google Podcasts, we're available there. I'd say YouTube is probably the best way to catch us, just because you can watch our beautiful faces talk. And you can hit the subscribe button, hit the little bell next to the subscribe button so you get updated when we post new videos. I guess you could go on and check out the other quarterly commentary and all that stuff too.
We'll be talking about refrigerators.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.